Most social media feeds make trading look like a permanent vacation. You click a few buttons on a laptop by a pool, and the money rolls in. The reality is quite different. Financial markets are incredibly efficient at transferring wealth from the unprepared to the disciplined. You are entering an environment where failure is the statistical norm. This creates a difficult position. You want to build a secondary income stream to give yourself a bit of breathing room, but you absolutely cannot afford to gamble away the savings you've already worked so hard for. So we have to redefine the goal right from the start. Your objective as a complete beginner is not to make a daily profit. Your primary objective is to survive the next 12 months without blowing your initial capital. This table breaks down the expectation gap. The left column is the myth you've been sold, that you'll secure a fixed daily income, win almost every trade, and quit your job by the end of the quarter. The right column is the actual path. Returns are entirely probabilistic. You will spend more time journaling your trades than executing them, and your entire focus will be on that one-year survival mark. This transition takes an emotional toll. If you approach the markets looking for a dopamine hit every time you open a chart, the stress will burn you out quickly. You have to treat this as a strict, almost boring administrative business. To make that happen, you need a highly rigid framework. We are going to look at 3 specific pillars: capital protection to keep you in the game, the liquidity strategy to find your edge, and the execution pipeline to deploy your plan safely. When you strip away the hype and treat trading as a disciplined mathematical process, you build a concrete defense against that 90% failure rate. Emotional panic is the fastest way to lose money in the markets. To remove that panic, you have to separate your trading capital completely from the money you need to live. We can map this out with a strict formula. Looking at this flowchart, if your regular monthly income from your job is $4,000, your maximum monthly trading risk must be capped between $400 and $800. That 10 to 20% is your hard ceiling. Capping your risk this tightly means your early dollar profits will be extremely small. That is a deliberate trade-off. By quarantining your real-world living expenses over here, your rent, your groceries, your bills, you guarantee that a bad month in the markets won't impact your actual life. Once you have that monthly pool, we apply the micro-level rule. You are never allowed to risk more than 1% of your trading account on a single trade. The math here is your safety net. You could take 10 consecutive losses in a row, a terrible streak for anyone, and you would still retain 90% of your operational capital to keep trading. Knowing the math is easy. Honoring it is incredibly difficult. It requires extreme psychological discipline to take a loss and walk away, rather than doubling your position size the next day in a desperate attempt to revenge trade and win it back. Intuition will lie to you when you are stressed. Mathematical capital constraints are the only reliable mechanism to protect you from your own emotional reactions during that first year. Now we need a method for actually entering the market. The first step is to strip away the noise. You do not need a screen covered in 5 different brightly colored technical indicators flashing conflicting signals. This quadrant chart breaks down strategic efficiency. Down in the bottom left, we have clustered indicators, methods that are highly complex but offer very low actual impact. Up in the top right is where we want to be, focusing on naked price action and liquidity. It's high impact, low complexity. Let's look exactly at what liquidity means on the chart. Big financial institutions need massive volume to move their orders. They find that volume by pushing the price into zones where thousands of retail traders have placed their stop losses. If you can read where those stop losses sit, you can align your trades with the actual market movers. Reading price action like this comes with a distinct trade-off. You will spend hours staring at the screen waiting for the market to reach your defined zones, and you will endure long stretches where no clear setup presents itself at all. To manage that wait, you implement a structural restraint rule. You strictly limit yourself to executing a maximum of 1 to 2 high-quality trades per day. Once you hit that limit, you close the laptop. Enforcing a daily limit does 2 things. It drastically reduces your exposure to sudden market manipulation, and it prevents decision fatigue from ruining your judgment as the day drags on. Your edge as a beginner does not come from catching every move. It comes from doing drastically less with much higher precision. Every volatile opportunity you choose to pass up translates directly into preserved mental capital. Having a strategy on paper is one thing. Actually deploying it into live markets requires a meticulous back-end process before you risk a single dollar. It starts with your broker. You must select a strictly regulated institution with entirely transparent fee structures. If a broker is taking massive hidden commissions on every trade, your math will never work out in your favor. The trade-off is convenience. A legitimate, regulated broker will require tedious identity verification and paperwork. Frictionless, offshore apps that let you trade instantly with a credit card are often completely unregulated and highly prone to disappearing with your funds. This deployment pipeline checklist outlines your required pre-launch sequence. You vet the broker, and then you face the grueling phase of backtesting. You take your strategy and manually test it against months of historical data, tracking every hypothetical win and loss. Your statistical goal during backtesting is to hit an 80% win rate. That sounds high, but you need that margin. Once you move to live markets, slippage, spread fees, and your own emotions will inevitably drag that 80% down closer to 60%. Finally, you must maintain a detailed trading journal. You meticulously log the setup, the result, and exactly what your emotional state was during the trade. This is how you identify the specific days, hours, or setups where you consistently lose money. This entire deployment pipeline is designed to be frustrating. Its true purpose is to forcefully expose your worst behavioral flaws and mechanical errors in a controlled environment, long before real capital is ever on the line. Let's pull everything together. Modern trading is not a ticket to a luxury lifestyle. It is a highly structured, often monotonous routine of risk calculations, chart review, and administrative journaling. The ideal candidate for this path is a methodical planner. You only risk disposable income. You accept the math, and you prioritize the strict survival of your capital over the urge to generate instant wealth. We can compare that directly against the profile of someone who should avoid the financial markets completely. Looking at this readiness matrix, the gambler uses essential capital, expects quick profits, and relies on gut feeling. The transitioner uses strict risk capital, expects probabilistic returns, and relies entirely on a back-tested strategy. Using rent money, grocery budgets, or emergency savings to fund a live brokerage account is a fatal error. The pressure to perform will guarantee that you make poor decisions. The same rule applies to your timeline. Entering the market with the expectation that you will replace your primary salary within the first 30 days is the fastest way to blow up an account. You will over-leverage to force a result that isn't there. Before you fund anything, you must complete a mandatory 30-day run on a simulated demo account. Treat it as the ultimate acid test. If you cannot maintain flawless discipline and execution accuracy with fake money, you absolutely will not do it with real money. Think of your first year in the markets purely as an expensive university degree.